Time now for a look at the day's business news with Brian Quinn. Brian, good to see you.
Hey, Monty, you too.
So we're starting in Europe, where the EU has just slashed its economic growth projection for this year.
That's right, Monty. Back in November, the European Commission predicted a growth of 4.2% for the bloc in 2021. Well, that was before the full extent of COVID-19's second wave had been registered on the continent. The EU is now predicting growth of just 3.7% in 2021 and 3.9% in 2022. That's after a drop of 6.8% in 2020. That 2022 projection, though, is actually an improvement over previous predictions, which had called for just 3% growth next year. The overall forecast is based on the assumption that lockdowns and curfews will start to ease in late spring as more and more Europeans are vaccinated. Also counts on economic stimulus measures being maintained. Here's Economy Commissioner Paolo Gentiloni.
As increasing numbers are vaccinated and containment measures are gradually relaxed, economic activity is expected to start picking up. This means, to speak in terms of the growth map, that blue waves are set to lift all boats in the EU, providing we avoid any premature withdrawal of supportive policies.
Next, London has lost its top spot as Europe's premier equities hub. Amsterdam taking over as the continent's largest trading center last month as new post-Brexit finance rules come into effect. Some 9.2 billion euros worth of shares changed hands daily on Dutch exchanges during January. That compared to just 8.6 billion per day in London. Despite the financial services industry making up around 7% of UK GDP, it was largely left out of Brexit trade negotiations. The process of bringing newly separate UK and EU regulations into agreement, known as equivalence, is set for a March deadline. England's top central banker says he believes Europe is trying to cut London's financial industry out of the continent's business. Here he is.
Well, as is well known, the post-Brexit equivalence process between the UK and the EU has not been straightforward. Now, the EU has argued that it must better understand how the UK intends to amend or alter the rules going forwards. This is a standard that the EU holds no other country to and would, I suspect, not agree to be held to itself.
Well, speaking of European equities, stock markets finished the day mixed as a strong February rally shows signs of losing steam. London's FTSE 100 with minimal gains despite a strong earnings report from Swedish pharma giant AstraZeneca. Paris on the other side of the flat line, while the Frankfurt DAX rose 0.75%. Amsterdam's AEX index up over 1% as it takes the top spot there. Wall Street also mixed Thursday as investors tried to keep the rally going after a worse than expected weekly jobs report. The Dow closing just under the flat line, the S&P up slightly with the Nasdaq gaining just over 0.33% amid a rebound in big tech stocks. Next, U.S. computer chip companies are seeking action from Washington amid a semiconductor shortage, which has seen automakers around the world begin to temporarily shutter factories in recent days. Intel, Qualcomm, and AMD among the companies who sent a letter to President Joe Biden Thursday asking Washington to provide, quote, substantial funding for incentives for semiconductor manufacturing. The U.S. chip industry has lost significant ground to Asia in recent decades, a situation that will be difficult to reverse. Luke Schrager reports.
Identifying the choke points in supply chains and working towards a review on a shortage of semiconductors. That's the aim of an upcoming executive order from the White House.
The review will be focused on identifying the immediate actions we can take, from improving the physical production of those items in the U.S. to working with allies to develop a coordinated response to the weaknesses and bottlenecks that are hurting American workers.
Semiconductors, the chips used in everything from household electronics to games consoles and cars, have been in short supply in recent weeks. Manufacturers switched from vehicular chips to those for household electronics after orders began drying up as the coronavirus pandemic worsened last year. It left Asian firms leading the sector unprepared to make up a shortfall. The US share of the global semiconductor market has fallen from 37% in 1990 to just 12% today. American chip makers want federal subsidies to help them compete, but even that may not be enough.
Is cemented in Asia for at least the next 3 to 5 years. We could start to see some movement in the U.S., but the way the supply chain works today, it's going to be an uphill battle to see any sort of factories built in the U.S., just given the pure cost efficiencies that we see throughout Asia.
In the meantime, automakers from GM to Ford, Renault and Volkswagen have temporarily idled factories, with the shortage set to last at least until autumn.
Well, finally, for business, the green energy transition, now widely accepted as necessary for keeping the planet livable, is also though likely to make paying the bills much harder for oil exporting countries. A new report from the Carbon Tracker Initiative shows that 40 such petro-states are likely to face an average 46% drop in revenues over the next 20 years if demand drops in line with emissions policies and new technology. That would represent budget shortfalls of some $9 trillion in 2040. The report urges oil-dependent states to diversify their economies as quickly as possible. It comes as major oil companies like Exxon have reported huge losses over 2020. Shell said Thursday that it's shifting its long-term focus to renewable energies. OPEC, though, says it still expects oil demand to increase through 2040. Carbon Tracker says in order to meet climate targets set out in global accords like the Paris Agreement, that demand will need to fall. The oil industry, of course, has been very slow to accept the new climate necessities, if you will. We'll have to see how the countries that depend on that income react as well in the coming decades.
Okay, Brian, thanks so much.